It's Friday, September 22nd. This is the market comment at xm.com by Mario Sachigiriakos. I'm Cristina Marujos. The storm in U.S. bond markets has evolved into a hurricane, inflicting deep wounds on riskier assets such as stocks. Yields on U.S. government bonds have gone ballistic, with the yield on 10-year notes hitting a fresh cycle high of 4.5% earlier today. When yields climb with such force, it has repercussions on every other asset class. Since yields are essentially market-determined interest rates, a move higher incentivizes investors to increase their allocation to cash and decrease their exposure to riskier plays like equities. This dynamic was on full display yesterday, with the S&P 500 losing 1.6% of its value as yields charged higher. Behind this fierce rally in yields lies a mismatch between supply and demand. The Fed raised its rate path this week, while Treasury continues to flood the market with newly issued debt to finance a gaping budget deficit. With a deluge of supply set to hit the bond market next quarter, while the Fed retains a stance of higher interest rates for longer, the upward pressure on yields could persist. Despite the stunning rally in U.S. yields and the ensuing sell-off in stock markets, the dollar did not manage to shine bright. Although the dollar index is headed for a weekly gain, the scope of the advance has not been impressive considering the seismic moves in bonds. Eurodollar is about to close the week almost unchanged, even though rate differentials have clearly moved in the dollar's favor. The stabilization in oil prices may have helped the energy-sensitive euro to gain some footing, alongside some signs that economic activity in Germany has started to bottom out. In the United Kingdom, the Bank of England shocked traders yesterday by keeping interest rates unchanged, citing slowing economic growth and a loosening labor market. The twist is that the Bank of England still tightened policy by accelerating the pace of its quantitative tightening program to £100 billion per year. The British pound fell sharply after the Bank of England decision, as the disappointment on interest rates joined forces with the retreat in stock markets to drag the currency lower. The pain train for sterling continued to roll on Friday following some dismal business surveys. Finally, the Bank of Japan kept its policy settings unchanged earlier today, as widely expected. Markets were searching for any signals about a potential exit from negative interest rates, but Governor Ueda pushed back against such speculation, sinking the yen in the process. This was today's market comment here at xm.com. Have a great weekend.